All right, let's get right into it. Today, we're taking a look at a massive company, Accenture, and we're going to put it through the ultimate test, the Warren Buffett checklist. The big question we're trying to answer is simple. Is Accenture a truly wonderful investment? So, how do you even spot a great investment? I mean, seriously. With all the noise out there, all the daily headlines, how do you find the real winners? It can feel kind of overwhelming, right? But what if I told you there's a simple, proven way to do it? Yeah, it's not some crazy, complicated formula only a Wall Street genius could understand. It's actually a pretty simple four-part checklist that Warren Buffett himself uses. It's super powerful, it forces you to be disciplined, and that's exactly what we're going to use today. So let's see if Accenture makes the cut. Okay, so here's the roadmap for today. We're going to tackle four key questions. First up, the business. Is it a great company? Is it built to last? Then we'll look at management. Are the people running the show smart and trustworthy? After that, we dive into the financials. Do the numbers actually prove its strength? And finally, the million-dollar question, the price. Is it on sale? Let's dive in. All right, part one, analyzing the business itself. And this is probably the most important piece of the puzzle. Do we actually understand what this company does? And even more important, does it have what Buffett calls an economic moat? Some kind of durable competitive advantage that keeps the competition at bay. And if you're not familiar with that term, an economic moat, it's exactly what it sounds like. Picture a giant castle. The moat is that big ditch of water around it, maybe filled with alligators, that protects the castle from being attacked. In business, it's what protects a company's profits from its rivals. So, what about Accenture's moat? Well, it's got a few things going for it. First, and this is a big one, high switching costs. Think about it. Once Accenture is deep inside a company running their entire IT system, it's not like you can just unplug it. It's woven into the very fabric of the business. Trying to switch to a competitor would be a nightmare. Super expensive and super risky. Then you've got their brand. It's a huge intangible asset. I mean, for a CEO of a Fortune 500 company, hiring Accenture is just the safe bet. Nobody gets fired for hiring Accenture. And finally, their sheer scale. They have this massive global army of really smart people. How many companies can compete with that? Very, very few. So when it comes to the business itself, it's a huge pass. Check. Accenture has a fantastic business with a really wide moat. But, a great castle is useless if the people running it are fools. So that brings us to our next question. What about the management? Okay, part two, judging the management. Are the leaders of this company, the CEO and the board, both trustworthy and smart with the company's cash? Because let me tell you, even the best business in the world can be run into the ground by bad leadership. And you can see the proof right here. Look at what they do with the profits. They consistently grow the dividend. That's cash right back in your pocket. They buy back their own stock, which makes your shares more valuable. And their acquisitions, they're smart. They're not doing these massive, risky mergers just for headlines. They're doing small, strategic, tuck-in acquisitions. Basically, they're playing the long game, focused on creating real value for shareholders, not just making a splash. So, yeah, another big check mark. Management gets a pass. They seem to be doing all the right things. Okay, so we've got a great business and great management. The story is sounding really, really good. But stories are one thing. The numbers have to back it up. So let's see if the financials tell the same story. All right, part three, checking the financials. This is where the rubber meets the road. If the business and management are as good as they seem, we should see it in the numbers. Let's pop the hood and see what's going on. Wow, okay, the first number that jumps out is just incredible. It's the return on equity, or ROE. And what that means in simple terms is for every single dollar of shareholder money in the business, Accenture is generating about 24.5 cents in profit every year. Now, to put that in perspective, Buffett usually looks for something above 15%. Accenture is crushing that. This is just exceptional. And this chart really drives the point home. That line there, that's the 15% Buffett benchmark. That's already a high bar. And look at Accenture. They're not just getting over the bar, they're pole vaulting over it. It's just a sign of an incredibly profitable business. So where does the money for all this growth come from? Are they taking on a mountain of debt? Nope. As you can see here, the company is financed mainly by its own profits, its retained earnings. They're growing organically, using their own cash. It's a sign of a super healthy, resilient business that doesn't need to rely on banks to fund its operations. Okay, so let's recap. The financials, they're basically perfect. High returns, low debt. It's exactly what you want to see. So that's 3 for 3. Check, check, check. By all measures, Accenture is a wonderful company. But, and this is a huge but, that doesn't automatically make it a wonderful investment. And that brings us to the final and honestly the toughest test of all. Part 4, calculating the price. This is it. This is the moment of truth. We know it's a great company, but are we paying a great price for it, or are we overpaying? In other words, is this wonderful business on sale? Okay, so when you do the math and try to figure out what the business is actually worth, its intrinsic value, you get a range somewhere between, say, $270 and $305 a share. And right now, the stock is trading at $250. So at first glance, you're thinking, yes, it's a bargain. We're buying it for less than it's worth. But hold on a second. It's not quite that simple. Because here's the thing. Smart investors don't just want a discount. They want a big discount. This is what's called the margin of safety. It's your buffer in case you're wrong or in case something bad happens. It's the difference between buying something for $9 when it's worth $10 versus buying it for $5. You want that big cushion. So the real question is the discount on Accenture big enough to give us that cushion? And when we run the numbers, this is where the story takes a turn. Look at this. Even if we use the high-end estimate of its value, the discount, the margin of safety, is only about 18%. That's just not enough. Disciplined value investors typically want to see a margin of safety of at least 20%, sometimes more. And based on these numbers, Accenture just doesn't clear that hurdle. And so, for the first time in our analysis, we have a fail. Accenture, as wonderful as it is, fails the valuation test. The price just isn't right. It's not cheap enough to provide that margin of safety. And for a value investor, that's a deal breaker. So where does that leave us? Let's recap. We've got 3 huge green checks for the business, the management, and the financials, but 1 big red X on the price. Let's pull it all together for the final verdict. And honestly, I think this phrase just nails it. A wonderful company at a fair price. That's the perfect summary. It's not a bad company, it's a wonderful one. But the price isn't a bargain, it's fair. The market knows it's a great company, and you're paying for that quality. So what's the move? The recommendation here is a hold. This isn't a sell signal, and it's not even a hard no. It's a not right now. The smart play is to put Accenture on your watch list. You wait. You wait for a better price. Maybe the whole market takes a downturn, and you can pick it up for a price that does give you that margin of safety. Something maybe below $225 a share. That's the moment when a wonderful company becomes a wonderful investment. And that's really the key takeaway here. It's one thing to identify a wonderful company. We did that. It's another thing entirely to have the patience and the discipline to wait for a wonderful price. That's what investing is all about. So we know Accenture is a great company. The question you have to ask yourself now is, what's your price? At what point does this great company become a no-brainer investment for you?